Matt from Invexor Trade. Just going to give you a overview and some slides which I'll share with the group on risk management. This is the number one area people fail in trading, I suspect. And obviously from first-hand experience, having worked with people, I can see that it's not always taught exactly what risk management should be. Part of the reason for that is a lot of the courses are provided by brokers who might be, it's not in their interest necessarily for you to succeed at this game. We'll go through some key tips that you can use, and everybody is different. Everybody's got a different outlook on time. Everyone's got different strategy. Everyone's got different risk appetite. So we're going to try and give you some tools that whatever your bank balance, your risk appetite, and your time perspective, you'll be able to adjust to your own needs and your own desires and your own outcomes. And one of the biggest things in trading is knowing what your outcome is, what your strategy is. What do you want to achieve? Some people want to do a certain amount of pips or pounds per day. Other people, want to look at long-term investments. So trading is all different types. You can't just call it trading. There's, day trading, swing, scalp, long-term investments, all sorts. So it's really important that you understand some key principles, whatever you're looking to achieve. And again, the whole point is to keep your account in funds. If you blow your account, that's really not where you want to be. Psychologically, it causes you problems. Obviously, financially, it can cause you problems. So the whole point of trading is to stay in the game. If you're in the game and you've got funds to trade with, you can always recoup losses. If you blow your account, then you're done. And you have to refund it if that's what you want to do. So we'll give you some tips here. First thing I always say is you should have 20 trades from the account. So whatever your account balance is, you need to be able to have 20 trades. Most people, should be doing 1 and 2 trades even as a beginner. Correct? And the bit that separates people from winning or losing, because 50% you can actually make be a profitable trader. What that means is that those 50% of trades have to be a lot more profitable than the 50% of losses. So it's not always about the percentage game. There's other traders which can have 90-95% successful trades. But again, all that good work can be undone if they cut their winners too quickly and they let the losses build up. So, at Invexor, we're probably 85-90%, and we've got a decent strategy, when to take our pips and when to cut the losses. And obviously, if everyone in the group, you should have the tools at your hand. Feel free to contact me if you need me to go through anything again. But I'll just work out here very, very roughly. You always want 20 trades from the account. That gives in some losses. If you've got a 75% win, means that you might lose 5, but you're going to win 15 as long as that ratios of letting the winners run works compared to cutting the losing positions. You're going to be in a good, strong position. A bet size is absolutely critical. Cannot stress that enough. As you're learning, you need to be small. You need to be focusing on pips and not pounds. Developing your strategy, and then you can build the bet size as you move up. And I'll show you on the next slide how that will work. But again, know the market you're trading, know the margin requirements. Different brokers have different margin requirements. Something, for example, the FTSE or even the DAX to a certain extent might be more manageable on the margin side, and the way that it moves, the volatility of those indices, whilst they can change, might not be as volatile as something like Wall Street, Dow Jones Industrial Average, which can swing 100, 200 pips in seconds. So depending on what market you're trading, you want to have different bet size so you don't get caught out. And then, of course, we need to be using our entry system, which is identifying the price area with channels, with Fibonacci, with gaps, supports, resistances. Then we're using our tools, such as divergence on, Awesome Oscillator, the RSI, RSI crossovers. And then, of course, once we've got the entry confirmation, we want to say what size per pip am I going to use, where's my stop loss, and where's my total profit. So again, we are looking at 20 trades from your account, 5% that is per trade. So I'll show you an example with a £2,000 account on the next slide. But what you want to be doing is giving yourself enough margin. Sometimes traders will blow their account on a single trade because they're not confident of where to cut the stop, where to ensure that stop loss is cut. And that one, they go too big, they're so convinced that the trade is going to go right, then rather than whatever it might be, £2 a pip or £100 a pip, whatever their normal stake is, they might be so confident, or they might be chasing the previous loss, that they'll all of a sudden double, triple, quadruple. So if they were doing £2 a pip before, they now might go £10. If they were doing £100 a pip before, they might now go £500. But what that does is it loses focus. You're then trading emotionally. You're losing focus of trading like a robot and making sure that your funds are protected. It's really, really important that you have strict risk management. So again, in this example, I'm just keeping it at £2,000, and any, if you've got £100,000 pot, you can work it out exactly the same. If you've got £1,000 pot, you can work it out exactly the same. So you want 20 trades from that. So that would mean that each trade, I'm only wanting to risk £100. So again, this is why in the indices or the instrument, whether it's forex indices, shares in a company, crypto, whatever it is, you want to be risking 1/20th as a maximum. That'll keep you in the game. That'll give you longevity. So again, on this one, if I was doing 100 pips as my stop loss after I've found the entry price and all the rest of it, then the maximum I can risk is £100. Is a pound, which would be a total risk of £100. Again, if your stop loss is only 50 pips and you're very confident and everything lines up, the three points line up for our entry, then you can say I'll do £2 a pip. Okay. Bad practice again, which I just touched upon, is the pot size £2,000. The trade needs to be a 50 pip stop loss, and you're £5 a pip, then you're risking £250 on one trade. In your mind, you might think, well, that's not too bad because I've got £2,000 to play with. But then if you lose 3 losses in a row at that level, there's £750 half your account. Then you find yourself chasing, winning it back. Emotional response, really not good. Cuts it too fine. And again, like I say, whatever your pot size is, you can then use exactly the same principle of doing that. Most traders that I've known in the past, that I'm currently working with, even myself, at some points, when you're so hyped up and you so believe that you're right, the temptation is to increase the pounds per pip. On times that can pay off, and you feel the best in the world. I knew I was right. I've made a load of money. Look at me, I'm great. But then if it goes the other way, you can lose all of that, and that is not a nice feeling. Worse than that is it then puts extra pressure on yourself because you've blown a load of your account. Then you're trying to chase the loss, whereas what you want is to be consistent, steady gains all the time. The stop loss is as I view it, an insurance policy, something that you never want to use or never want to be hit, but it's there to prevent you losing more money. So if you don't know where to put the stop loss, then in plain simple English, don't place the trade. You need to be very, very strict. You should need to have confidence in your trade and obey the stop loss. A lot of traders, what they can do is it starts running, and again, emotionally or psychologically, they think they're right. So they say, well, I know it's going to come good. I'll just move my stop loss 10 pips. So what might have been £100 loss then goes to 120. I think, I can afford an extra £30, so I'll move it along an extra 30 pips. I'll move the stop loss, and before you know it, they keep doing it, and then the loss gets too big to close. They think it's, they can't afford to drop it. So that all stems from the very first stage of moving that initial stop loss. You need to make sure your stop loss is in the right place. If it is in the right place, then you have to obey it. Those couple of times you move it, and then it turns and comes good, they're actually doing you more harm than good, because it's creating bad habits, and it's creating you to to keep moving it. And it might be good a couple of times, but that 1 or 2 times it doesn't work, it will hurt you very, very badly. So always obey that. Make sure you've got it in the right place. If you're not confident of where it should be, then you shouldn't really make that trade. You should only trade it if you're confident and you know as best as you can what's going to happen in the market. So I'm hoping that you can use these key points now, really, just to help you stay in the game. Especially if you're new, risk management is the most important thing. Having a plan that you can execute like a robot, not being emotional, not trading on what you think should happen or what might happen. You have to get your plan in place. You have to trade it as best as you can using the three-pronged attack, which is price area, entry confirmation, and then the risk management. Risk management, you need to stay in the game. If you blow your account, you're out of the game. So hopefully that helps. Any questions, feel free to obviously comment on the video and get in touch with me.